Welcome back. China is reportedly advising banks in the country to limit exposure to U.S. treasuries, and a sign that the U.S. assets could be less appealing on the global stage. But our next guest just published an op-ed in the Financial Times arguing that while foreign investors have been bashing many U.S. policies, they're still pouring money into American assets. Joining us now is Rockefeller International Chairman Ruchir Sharma. Obviously, it's topical with this report, Ruchir, that China's telling banks to limit exposure to treasuries. And we have seen China, its own central bank, cutting down the amount of treasuries that it's been buying. So what do you think is going on here?
So, Sarah, yes, that's correct. That as far as central banks are concerned around the world, they've been diversifying outside of treasuries in the US dollar and principally buying gold. But if you look at the overall portfolio flows, which includes stocks, corporate bonds, and other such assets, those hit a new record high in 2025. That we got nearly $1.6 trillion of portfolio investments into the US. That is much higher than what we have seen for the last decade, even in 2024. And that's what I write, that this whole sell America narrative is a myth, which is that except for the month of April last year, when you got outflows on the back of the massive tariff tantrum, I think apart from that, every single month, we aggressively saw foreigners buying stocks and corporate bonds and other similar assets. So therefore, there is no sell America going on. And foreign investors around the world, when I meet them, they say something during the day, but at night on trading platforms from Seoul to Singapore, they're staying up till 4 and 5 a.m. and buying American stocks.
Yeah, I mean, you can't compete with the AI story that's going on here, the productivity story that's going on here, the capital spending. I guess, I mean, it all makes sense except for the U.S. dollar, which is down almost 2% to start the year, more than 9% last year. I mean, these are more pronounced declines than we typically see for a currency.
Yeah, Sarah. So I think that's the real risk as far as America is concerned, which is that the rest of the world's stock markets, in fact, outperformed last year, despite the fact that no one seemed to be really selling America, they were buying America. So the fact that despite such strong inflows that America got last year, the market still underperformed, even though it was up a healthy 18% or so. The fact that it underperformed the rest of the world's markets is a bit concerning because the US is running a current account deficit of $1.3 trillion. So that's the math. You got a current account deficit of around $1.3 trillion. And you got portfolio investments coming in at $1.6 trillion. So it's all being financed by the so-called hot money. If there's a change in confidence on that, I think then the consequences could be quite real. But otherwise, the dollar can weaken. It's happened in the 2000s as well. That the dollar can weaken, and yet that doesn't have any visible impact on the market overall. But it does impact relative performance. And so therefore, the theme that we spoke about a year ago is that I think that this trend of American exceptionalism, where America was the only place in the world to invest, I think that has come to an end. But what you're still seeing is that the foreign interest in America still remains high, but just that the rest of the world's markets are doing quite better. So it's sort of closing the gap on the upside rather than on the downside in terms of relative performance.